Something has shifted in the precious metals market, and if you've been watching gold and silver over the past several months, you've felt it. Not as excitement necessarily, but as something deeper, a kind of tension that makes experienced investors pause and newcomers question whether they understand what they're looking at. The swings have been violent. 1 week silver climbs 8%. The next, it erases those gains in 48 hours. Gold touches new nominal highs, then retreats sharply, leaving half the financial media declaring victory and the other half calling it a bubble. The noise is deafening, the clarity is rare. But here's what matters. This isn't about day-to-day price action. It's not about predicting whether tomorrow will be green or red. What's happening in the metals market right now is a reflection of something much larger, something that has been building for years and is now entering a phase that will test the resolve, discipline, and understanding of every investor who holds these assets or is considering them. This is not a crisis in the traditional sense. It's a transition. And transitions are always uncomfortable. They reveal who prepared and who speculated, who understood the reasons they owned an asset, and who simply followed a crowd. If you hold gold or silver right now, you need to understand what this volatility actually represents. If you don't hold them but have been watching from the sidelines, you need to know what you're really looking at before you make any decision. Because what's unfolding isn't noise, it's signal. And knowing the difference between the two is what separates investors from gamblers. Let's walk through this carefully. No hype, no fear, just clarity. To understand why the metals market feels different right now, we need to step back from the price charts for a moment and look at what's happening in the broader financial system. For over a decade, central banks around the world operated in a world of near zero interest rates and unprecedented monetary expansion. Trillions of dollars, euros, yen, and yuan were created to stabilize economies, fund government spending, and prevent financial collapse. That environment created specific conditions. It rewarded borrowing, punished saving, inflated asset prices across stocks, bonds, and real estate, and pushed investors into riskier and riskier positions just to achieve modest returns. Precious metals existed in that world as a kind of shadow asset. They didn't produce yield. They didn't pay dividends. They just sat there, quietly holding value while everything else inflated around them. Some investors understood why that mattered. Most ignored them entirely. But that era is ending. Or more accurately, it's fragmenting. Central banks raised interest rates aggressively to combat inflation that finally broke into the open. That made bonds attractive again, at least temporarily. It strengthened the dollar, at least for a while. And it created the illusion that perhaps the old playbook still worked, that perhaps the system could return to stability without any real cost. Except the math doesn't support that story. Government debt levels have reached points where servicing that debt becomes a larger and larger portion of national budgets. The United States alone is paying over $1 trillion annually just in interest. That's not principal. That's just the cost of having debt. And when interest rates are higher, that cost grows rapidly. So central banks face an impossible choice. Keep rates high and watch governments struggle under debt burdens, or lower rates and risk reigniting inflation. Either path creates instability. Either path erodes confidence in currency. And that's what's changed. The gold and silver market is beginning to price in a reality that many traditional investors still refuse to acknowledge, that the monetary system is under structural pressure, that the easy solutions have been exhausted, that the next phase will not look like the last one. This doesn't mean the sky is falling. It means the ground is shifting. And assets that hold value independently of any government's printing press or any central bank's policy decisions start to look different when that shift becomes undeniable. The volatility you're seeing isn't irrational. It's repricing. It's the market trying to figure out how much that shift matters, how fast it will unfold, and what it means for every other asset class. That process is never smooth. It's messy. It's emotional. And it will continue until a new equilibrium is found. Here's where most investors get lost. They look at gold and silver as investments in the traditional sense. They ask, what's the return going to be? They compare them to stocks or bonds or real estate and try to run the same calculations. But precious metals aren't just investments. They're insurance. They're monetary assets that have held value for thousands of years, across empires, across currencies, across every financial system humanity has created. When you own gold or silver, you're not betting on a company's earnings or a government's policy success. You're holding something that exists outside that system entirely. Most people don't think this way because they've been trained not to. For decades, the financial industry has taught everyone that the only assets worth holding are those that generate returns, that produce income, that can be leveraged and traded and optimized for short-term gains. And in stable times, that framework works reasonably well. But we're not in stable times. We're in a period where the assumptions underlying that entire framework are being questioned, where the reliability of currency itself, the foundation of all financial transactions, is showing cracks that can't be papered over with another round of stimulus or another central bank intervention. When inflation runs persistently above target, When real yields on government bonds turn negative after accounting for actual price increases, when the purchasing power of wages declines year after year despite rising nominal income, people start to feel that something is wrong even if they can't articulate exactly what it is. Gold and silver become relevant not because they're going to double overnight, but because they represent stability in an increasingly unstable system. They don't depend on a corporation's management decisions. They don't rely on a government's fiscal discipline. They simply exist, scarce and tangible, as a store of value that has survived every financial crisis, every currency collapse, every period of monetary chaos in recorded history. Most investors miss this because they're looking for the wrong signals. They watch the stock market and assume that as long as equities are rising, everything must be fine. They see housing prices climb and interpret that as prosperity rather than currency debasement. They trust that central banks have everything under control because central banks say they do. But experienced analysts, the ones who have studied monetary history and understand how these cycles unfold, are watching different indicators. They're watching the velocity of money. They're watching credit creation. They're watching the gap between official inflation figures and what people actually experience when they buy food, pay rent, or fill their gas tanks. And they're watching the accumulation patterns of central banks themselves, many of which have been adding gold to their reserves at the fastest pace in decades. These aren't conspiracy theories. These are publicly available facts. But they don't fit the narrative that most people want to believe, the narrative that everything will return to normal if we just wait long enough. So they're ignored or dismissed until the evidence becomes impossible to deny. The volatility in the metals market right now is the collision between those who are beginning to understand these dynamics and those who still believe the old framework will hold. It's a tug of war between traditional financial thinking and a growing recognition that the rules have changed. Let's look at history, not to predict the future, but to understand patterns. Because while every crisis is different in its details, the underlying dynamics tend to rhyme. In the 1970s, when inflation broke out of control and the post-war monetary system collapsed, gold went from $35 an ounce to over $800 in less than a decade. But that journey wasn't a straight line. It was marked by brutal pullbacks, periods where the asset fell 30 or 40% before continuing higher. Investors who didn't understand what they owned sold at the worst possible times. Those who understood the thesis held through the volatility and preserved enormous amounts of wealth. In the years following the 2008 financial crisis, when central banks began the unprecedented expansion of their balance sheets, gold climbed from around $700 to over $1,900 by 2011. Then it fell. Hard. For several years, it declined while the stock market soared and mainstream analysts declared that gold was dead, that it had been a bubble, that anyone holding it was foolish. But what actually happened? The monetary expansion that began in 2008 didn't stop. It continued. Debt kept growing. The structural problems in the financial system weren't solved. They were papered over. And by 2019, before anyone had heard of a global pandemic, gold was quietly making new highs again. By 2020, it had blown past $2,000. Silver, which had fallen below $14 at its lows, surged past $30. These aren't anomalies, they're cycles. And cycles have characteristics that repeat. They have phases of accumulation, where smart money builds positions quietly. They have phases of breakout, where the asset begins to attract mainstream attention. They have phases of volatility, where weak hands are shaken out and conviction is tested. And they have phases of acceleration, where the move becomes undeniable and everyone wishes they had bought earlier. Right now, the metals market is in that volatile middle phase. The accumulation has happened. Central banks, institutional investors, and long-term holders have been building positions for years. The breakout has happened. Gold has made new all-time highs. Silver has begun to show signs of life after years of relative dormancy. But the acceleration hasn't fully arrived yet, and that's what creates this uncomfortable in-between space. Prices swing wildly because the market is trying to reconcile two opposing forces. On one hand, the fundamental case for holding precious metals has arguably never been stronger. On the other hand, the traditional financial system hasn't collapsed. Life continues. Most people aren't experiencing the kind of crisis that forces them to question everything. Historically, this is exactly when the most important moves happen. Not when everyone agrees, not when the trend is obvious, but when the outcome is still uncertain enough that most people remain skeptical, when the volatility is intense enough to scare away casual participants, when the narrative hasn't yet shifted in the public consciousness. Those who understand this don't try to time every swing. They don't celebrate when prices rise or panic when they fall. They recognize that if the thesis is correct, if the underlying monetary and economic pressures continue to build, then the current price is largely irrelevant compared to where the asset will be in 5 or 10 years. And if the thesis is wrong, if somehow the structural issues resolve, if inflation magically disappears without consequence, if debt becomes manageable without crisis, then precious metals will simply sit there, holding value, doing what they have always done. There's no bankruptcy risk, there's no counterparty risk, there's only the opportunity cost of not being in something that performed better. That's the trade-off. And understanding that trade-off is essential to surviving periods like this without making emotional decisions. If you already own gold or silver, you need to ask yourself one critical question right now. Do you remember why you bought it? Not the surface reason, not because someone said it would go up or because you saw a chart that looked promising, but the real reason, the fundamental thesis, the understanding of what role these assets play in a portfolio and under what conditions they become most valuable. If you bought precious metals as a hedge against currency debasement, against monetary instability, against the long-term consequences of excessive debt and money printing, then nothing about the current volatility should change your position. Those conditions haven't gone away. They've intensified. The swings in price are noise. The underlying signal is unchanged. This is where discipline matters most. It's easy to hold an asset when it's rising smoothly. It's easy to feel confident when everyone around you agrees with your decision. But real conviction is tested in moments like this, when prices whipsaw, when the financial media declares the trade dead, when your portfolio value fluctuates uncomfortably from week to week. Experienced investors know this feeling. They've lived through it before. They understand that volatility is the price you pay for holding assets that exist outside the mainstream system. When the system appears stable, those assets feel unnecessary. When the system shows cracks, those assets become invaluable. But the transition between those two states is never comfortable. So what should you do? Nothing reactive. If your position is sized appropriately, if you're not over-leveraged, if you haven't bet money you need for living expenses, then the rational move is to hold steady and continue to monitor the fundamental factors that led you to buy in the first place. Are debt levels declining? No. Are central banks credibly reducing their balance sheets? Not in any meaningful way. Are governments demonstrating fiscal discipline? The evidence suggests otherwise. Is inflation truly under control, or has it simply moderated slightly while remaining elevated? Look at your grocery bills. Look at your insurance premiums. Look at the cost of health care or housing. If those fundamental factors remain in place, then short-term price volatility is just that, short-term. It tells you nothing about the long-term outcome. It only tests whether you truly understood what you owned and why you owned it. One more thing for current holders. This is not the time to become complacent or greedy. If your allocation to precious metals has grown significantly due to price appreciation, it might make sense to rebalance, to take some profits, to ensure that no single asset dominates your portfolio so much that its volatility becomes destabilizing to your overall financial picture. Discipline works both ways. It means holding through downturns when the thesis is intact, and it means trimming positions when they grow beyond prudent levels. The goal isn't to get rich from gold and silver. The goal is to preserve wealth, to maintain purchasing power, to have financial insurance in place if and when the broader system faces real stress. If you keep that goal in mind, the current chaos becomes manageable. If you've been watching from the sidelines, trying to decide whether now is the right time to add precious metals to your portfolio, the volatility probably feels intimidating. You might be thinking, should I wait for prices to come down? Should I jump in before they go higher? What if I buy at the top? These are natural questions. But they're also the wrong questions, because they frame the decision in terms of short-term price movement rather than long-term portfolio strategy. Here's the better question. Do you have adequate protection in your portfolio against monetary instability, currency debasement, and the potential consequences of unsustainable debt levels? If the answer is no, if your wealth is entirely denominated in paper assets and bank deposits, if you have no exposure to hard assets that exist outside the traditional financial system, then you have a gap in your financial defenses, regardless of where gold and silver prices are today. The purpose of owning precious metals isn't to speculate on their price, it's to reduce systemic risk in your overall portfolio. It's to ensure that if the financial assumptions that underpin everything else prove unreliable, you have something that will maintain value. Does that mean you should rush out and convert half your portfolio into gold and silver tomorrow? Absolutely not. That would be just as irrational as having no exposure at all. What it means is that you should consider a measured, strategic allocation, sized appropriately to your risk tolerance and financial situation, and then build that position thoughtfully rather than emotionally. In volatile markets, one of the smartest approaches is to average in slowly. Don't try to time the perfect entry. Don't wait for confirmation that the trend is clear, because by then you'll be buying at prices significantly higher than today. Instead, decide on a reasonable allocation, perhaps 5 to 10% of your investable assets, and build that position gradually over time. This approach removes the emotional pressure. It ensures you're not overexposed if prices pull back. It guarantees you're not sitting entirely on the sidelines if prices accelerate. It's the approach that experienced investors use because it prioritizes discipline over prediction. But before you make any purchase, you need to do something more important. Educate yourself. Understand what you're buying and why. Read about monetary history. Study the role of gold and silver across different economic systems. Learn about the differences between physical ownership, ETFs, mining stocks, and other exposure methods. Understand the trade-offs of each. Don't buy because someone online said it's going to the moon. Don't buy because you're afraid of missing out. Buy because you've done the work to understand the thesis, you've considered how these assets fit into your broader financial strategy, and you're prepared to hold them with patience and discipline regardless of short-term price movement. If you can't articulate why you own something, you'll sell it at the worst possible time. If you understand deeply why you own it, you'll be able to hold through volatility and benefit from the insurance those assets provide when it matters most. Let's talk about the mistakes that destroy wealth during volatile periods, because these mistakes are predictable, common, and entirely avoidable if you recognize them ahead of time. First, do not react emotionally to daily price swings. If you're checking gold and silver prices multiple times a day, feeling elated when they're up and anxious when they're down, you're engaged in behavior that will lead to poor decisions. Set your strategy, implement it, and then step back. Review your positions quarterly, not hourly. Second, do not chase headlines. The financial media makes money from your attention, not from your success. They will amplify every swing, frame every move as either euphoria or disaster, and create narratives that have nothing to do with underlying fundamentals. If your investment decisions are driven by what you read in clickbait articles or saw in sensational YouTube thumbnails, you will consistently buy high and sell low. Third, do not over-leverage. This is perhaps the most dangerous mistake. Some investors, convinced that precious metals are going to rise significantly, use borrowed money or derivatives to amplify their exposure. This is speculation, not investment. And in volatile markets, leverage is the mechanism that turns temporary drawdowns into permanent losses. If you own physical gold and silver outright, a price drop is just a number on a screen. If you're leveraged, that same drop can force liquidation, crystallizing losses at the worst possible moment. Fourth, do not blindly follow online influencers or anonymous social media accounts promising massive short-term gains. The precious metals community, like every investment community, has its share of hype merchants who make bold predictions with no accountability when they're wrong. Learn to distinguish between serious analysis and entertainment. Serious analysts discuss probabilities, risks, and scenarios. Entertainers promise certainty and spectacular returns. Fifth, do not ignore diversification. Yes, precious metals may play an important role in your portfolio, but they should not be your entire portfolio. You need cash for liquidity. You need income-producing assets. You need exposure to productive businesses if you're building long-term wealth. Precious metals are insurance, not a get-rich-quick scheme. Treat them accordingly. Sixth, do not confuse paper exposure with physical ownership. ETFs and mining stocks have their place, but they carry different risks than holding physical metal. ETFs have counterparty risk. Mining stocks are leveraged bets that move with both metal prices and equity market sentiment. If your thesis is about systemic financial risk, then your core position should be in physical metal that you own outright, stored securely. Everything else is a trading position, not insurance. Finally, do not assume that because something has happened in the past, it will happen the same way in the future. Yes, history provides patterns. Yes, cycles repeat. But the timing, magnitude, and specific path are never identical. Anyone promising you exact price targets or specific dates is guessing, no matter how confidently they present their case. The investors who survive volatile periods and come out ahead are the ones who recognize these traps, avoid them deliberately, and maintain emotional discipline even when everything around them feels chaotic. So, where does this leave us? The precious metals market is volatile. The swings are uncomfortable. The narratives are conflicting. But underneath all of that noise, the fundamental dynamics are clear. We live in a world of unprecedented debt, aging demographics that strain government finances, political polarization that makes fiscal discipline nearly impossible, and a monetary system that has been stretched to its limits by more than a decade of extraordinary intervention. Gold and silver exist as alternatives to that system. They're not perfect. They don't solve every problem. But they offer something increasingly rare, an asset that cannot be printed, cannot be debased, and has maintained value across every financial system in human history. If you understand that context, the current volatility becomes something you can manage rather than something that controls you. You recognize that big moves in these markets don't happen smoothly. They happen in waves, with corrections that shake out weak hands and test the resolve of everyone involved. Your job as an investor isn't to predict every twist and turn. It's to understand the larger forces at play, position yourself accordingly, and then have the discipline to stay the course when others panic. For those who already hold gold and silver, remember why you bought. If the thesis remains intact, hold steady. If your allocation has grown too large, rebalance thoughtfully. But don't abandon your position because of short-term noise. For those considering an entry, Educate yourself first, build a position gradually, size it appropriately, and understand that you're buying insurance, not making a bet on next week's price movement. For everyone, stay informed, stay disciplined, and recognize that the most important investment you can make right now isn't in any particular asset. It's in your own financial education. It's in understanding how money works, how systems fail, and how prepared investors navigate uncertainty. The chaos in the metals market isn't a crisis. It's a signal that something larger is unfolding, something that will reshape how we think about value, currency, and wealth preservation in the years ahead. Those who are prepared, who have done the work, who understand what they own and why they own it, will look back at this period not with regret, but with recognition that they made thoughtful decisions during a crucial transition. The path forward isn't about predicting the future. It's about understanding the present clearly enough to make intelligent choices that protect what you've built and position you for whatever comes next. Stay calm, stay educated, and remember that in times of uncertainty, knowledge and discipline matter more than any hot tip or bold prediction ever will.